Explicit versus implicit costs. Now, what are explicit costs? Explicit costs are costs that are directly stated. These are the accounting costs. These costs are clearly expressed. It is marked on the good or the service or the particular material or the resource that we are using for the production. Let's say the cost of raw material or the wages of labor, the cost of electricity or our water bills, our utility bills are all explicit costs. We don't have to gauge or think of what these costs could be. It is clearly expressed. But implicit costs are the indirect costs or the opportunity costs. These costs are not recorded anywhere. These are not the type of costs that accountants take into consideration. So, for example, depreciation of an equipment, the purchase of a new blender in a cafe that had to be given up because they purchased a new mixing machine. Now, a cafe might have decided and bought a mixing machine, but because they bought the mixing machine, they would have given up buying a blender. Now, in our accounting books, we don't record these kind of transactions. The interest lost on income. Let's say if there was a certain amount of um, money that we had invested, not invested, saved in an account, in a fixed deposit, let's say, and we were gaining an interest payment because of the fixed deposit. But if we use this fixed deposit money, if we withdraw it and use it to purchase a capital or spend it on our business, the interest that we lost from the fixed deposit or the interest that we could have got from the fixed deposit is not recorded anywhere, and that is an implicit cost. So, accounting profits, where accountants record, they will look at the total revenue made by the firm and they reduce the explicit costs. They only consider the costs that are recorded. They don't consider all the opportunity costs. So, accounting profit is equal to total revenue minus the explicit costs. But economic profit is equal to the total revenue minus both explicit and implicit costs. So, economic profit looks at all these unrecorded costs associated with the production. In other words, economic profit is equal to accounting profit minus the implicit costs. So let's take an example. Say you're in a restaurant, they spend $400 on fruits and vegetables, $20 on electricity, $100 on a new oven, $200 as the cost of labor, $2,000 the salary the owner had to give up in his previous job before owning the restaurant, and $1,000 as initial capital. And this restaurant has gained a revenue of 4,000. Now, fruits and vegetables, the costs are explicit. It is recorded. Electricity, again, it's recorded. The new oven that we purchase, it is also recorded. Therefore, explicit cost. The cost of labor is an explicit cost. But here, the salary that the owner had to give up in his previous job is an opportunity cost. He had to give up on that money in order to start this restaurant. So, if he didn't have this restaurant, he would have had that income. So, that is an opportunity cost, which is an implicit cost, which an accountant would normally not record. An initial capital, of course, is an explicit cost. So, when we calculate, we see Our accounting profit is equal to total revenue minus explicit costs. So we have our accounting profit equal to 4,000, our total revenue, and we minus all the explicit costs that were shown here. These factors are all recorded. And then we minus it from the total revenue and we get the answer $2,280. Economic profit, on the other hand, is the total revenue minus explicit plus implicit costs. Therefore, we have our explicit costs here and we add the implicit cost, this opportunity cost of the owner's earnings, 2,000. And here you see the economic profit in this restaurant is only 280. Therefore we must note that economic profit will always be less than the accounting profit. Economic profit is going to be less than the accounting profit because for the economic profit we add the implicit cost.